Welcome to the ProTicker Deep Dive.
Hey, it's really great to be back.
It is Friday, February 27th, 2026. And, honestly, I don't think there has been a week in recent memory where we needed to sit down and talk more than right now.
Yeah, I would completely agree with that. It's been a lot.
Because if you have been watching the markets or if you've been brave enough to actually log in and look at your portfolio anytime in the last 7 days, you have probably got a serious case of whiplash.
Whiplash is probably the most diplomatic way you could possibly put it. I mean, it has been a chaotic, confusing, and ultimately just a completely fascinating week.
It really has. I mean, let's set the scene here for everyone listening, just to ground us in the actual timeline.
Right.
If we rewind the clock just 5 or 6 days back to Monday morning, the narrative out there was absolute unmitigated doom.
Total doom and gloom.
We were talking about record outflows. People were literally screaming on social media that the cycle was over, the sky was falling. It felt really heavy.
It felt incredibly heavy. And you have to remember, we were coming off 8 straight weeks of bleeding.
Right.
And that kind of relentless day after day selling pressure, it just grinds people down.
Yeah.
Emotionally, I mean.
Exactly. And then you fast forward to today, Friday afternoon, and the script has completely flipped.
100%.
It feels like we are living in a totally different reality than we were on Monday. So, frankly, I kind of want to play detective today.
I like that framing. We're basically investigating the crime scene of the market to figure out what actually happened.
Exactly. We are investigating the Great Reversal. That's the mission for today's deep dive.
Sounds good to me.
Because, look, we saw the year start with the absolute worst outflows since these ETFs launched. We're talking nearly $4.5 billion that just walked out the door.
It's a staggering number.
Yeah.
It really is.
It is.
It's the kind of number that, it shakes your confidence to its core. When you see billions just leaving the ecosystem, you naturally assume something is fundamentally broken.
Yeah, right. You think the thesis is dead, but then we get the twist.
A massive twist.
In just 3 days, this week, Tuesday, Wednesday, Thursday, over $1.1 billion flooded right back in.
Just an absolute wall of money.
Right. So the core question I really want us to answer for everyone listening today is pretty simple.
Lay it out.
Is this just a dead cat bounce? Is this a temporary little reprieve before we go lower? Or have the institutional giants, the real heavy hitters, finally decided that the bottom is actually in?
Well, that is the multi-billion-dollar question, isn't it?
Literally.
And to answer it, we have to look way, way beyond just the price of the asset. We have to look at the underlying mechanics.
Right, the plumbing.
Exactly. Who is selling, who is actually buying, and the absolutely wild macro environment we're sitting in right now.
Yeah, the macro stuff is bananas this week. So here's the roadmap for everyone. We are going to unpack the basis trade collapse, which honestly explains why the hedge funds just ran for the exits.
That's a huge piece of the puzzle.
Then we are going to look at the macro storm. We're talking tariffs, Supreme Court rulings, NVIDIA earnings, all of this hitting at the exact same time.
It's a perfect storm.
And we absolutely cannot ignore the market structure issues. We have to talk about that massive exchange glitch in South Korea.
Oh man, the Bithumb situation.
Yeah, and the conspiracy theories about paper Bitcoin that came out of it. I went down a total rabbit hole on that.
Oh, I'm sure you did. The timeline was wild this week.
We will definitely get into all of that. And finally, we're going to reveal who is actually doing the buying right now. Spoiler alert. It is not just retail traders sitting on their phones anymore.
No, the entire profile of the buyer has changed dramatically. It is a completely different animal today than it was even a year ago.
Okay, so let's just jump right into the first part here, the Great Reversal. Let's look at the anatomy of these flows. Because, reading numbers off a spreadsheet can be a little dry, but these specific numbers, they tell a story of capitulation and redemption.
They absolutely do.
Yeah.
And I think to really understand the profound relief of this week, you have to appreciate the pain that preceded it.
Oh, the pain was real.
For 8 solid weeks, the market just bled. We saw $4.5 billion in net outflows from the U.S. spot products.
That is nearly 2 straight months of just red days.
Essentially, yes.
Yeah.
It was a slow, agonizing, grinding bleed. And structurally, that wears market participants down way more than a sharp, sudden crash does.
Why is that?
Because a crash happens fast, you process it, and you move on. A slow bleed destroys sentiment because you wake up every day and it's just a little bit worse. It feels like there is literally no bottom.
It's death by 1,000 cuts.
Exactly. But then The bandage was finally applied on Tuesday, February 24th. That's when the turnaround officially began.
Just a little bit of green.
Right. But Wednesday was the absolute standout.
Wednesday, February 25th. That was the day the sun finally came out.
It was. In a single trading session, we saw $507 million in net inflows, $500 million in one day.
Just incredible volume.
And what is really notable to me, looking at the data, is that it wasn't just one single fund getting lucky. Sometimes you see one fund have a big day because of a specific institutional allocation.
Right.
But this time, all 12 ETFs showed inflows.
That is incredibly rare, isn't it? Usually in the past, we would see, say, the Grayscale fund bleeding out huge numbers while BlackRock buys, and the net result is just kind of flat.
Exactly. Or you'd have one minor fund see a tiny outflow while the big guys scooped up the rest. But this was completely green across the board.
Every single one.
It was a highly coordinated, macro-driven move. Capital is entering the system from literally every single entry point available in the U.S. market.
But I'm assuming the big two were still dominating the actual volume.
Oh, of course. As usual, BlackRock's IBIT and Fidelity's FBTC were doing the heavy lifting. They are essentially the giant vacuum cleaners just sucking up all the available supply on the market.
And the price action obviously reflected that. I remember looking at the chart early in the week, I think it was Monday night, and we dipped below 63,000. It looked genuinely scary.
It did. It looked like the floor was falling out.
It looked like we were about to fall off a cliff and go retest 50,000.
Yeah, breaking below 63K, it broke a key psychological level. A lot of the short-term technical analysts were on social media screaming, "Sell, get out now."
But then it just snapped back violently.
It snapped back incredibly fast. As of today, right now, we have cleanly reclaimed the 68,000 level. And this brings up a concept we discuss a lot in our internal research notes, which is institutional support.
Institutional support. Okay, I want you to unpack that for us because I hear that phrase a lot. Is that just, a fancy Wall Street way of saying rich people are buying?
I mean, sort of, but it is way more structured than that. Think about how retail traders operate. You, me, the average person sitting at home, we tend to be momentum traders.
Right. We buy when things are exciting. We see the green candles and we want in.
Exactly. When the price is going up, it's all over the news and we chase it. Institutions, the big sovereign money managers, pension funds, they operate completely differently. They operate on strict value zones.
So they buy when it actually hurts.
Precisely. They are contrarian by design. What we are seeing in the on-chain data and the ETF flows is that the mid-60K range, specifically that 60,000 to 64,000 zone, is emerging as a massive line in the sand.
A line in the sand.
Yes. Every single time we dip into that specific zone, the trading volume spikes, the ETF inflows aggressively return, and the price gets bid right back up. They are essentially telling the market, at this specific price point, we are highly interested.
It's almost like they have these massive multi-million-dollar limit orders just sitting there at 62K, just waiting for retail to panic so they can scoop up the cheap coins.
That is effectively exactly what is happening under the hood. They are providing the bedrock liquidity that absorbs all of that panic selling.
That makes a lot of sense. But we also have to talk about the fact that crypto doesn't exist in a vacuum. There was another massive catalyst this week, something totally outside of the crypto space that we have to mention.
The NVIDIA effect.
The NVIDIA effect. I swear, it feels like we can't go a single week in finance right now without talking about Jensen Huang and his leather jacket.
It's true. He is basically the macroeconomic weather vane right now.
Totally.
But you really cannot decouple crypto from the broader tech sector right now. It's impossible. NVIDIA released their earnings this week, and they absolutely crushed it. Again.
They just keep printing money. It defies logic.
They do. And what that did, from a macro perspective, is it signaled to the broader traditional market that the AI boom isn't over. Not even close.
And how does that translate to crypto?
It's all about risk-on sentiment. That willingness for portfolio managers to bet on growth and frontier technology, it spilled over. When tech stocks fly, crypto almost always catches the tailwind. We've seen Bitcoin increasingly trade like a high-beta tech stock during these specific earnings seasons.
High beta, just meaning, for anyone new to the term, that it moves in the exact same direction as the tech sector, but just way more violently.
Exactly. If the NASDAQ goes up 1% on a given day, Bitcoin might go up 3 or 4%. It acts like a levered, supercharged bet on technological innovation.
Right.
So NVIDIA goes up, everyone on Wall Street feels richer, their portfolios are green, they feel more confident, and that excess liquidity flows directly into other risk-on assets. And Bitcoin is right at the top of that list.
Okay, so that perfectly explains the why of the massive buying we saw this week. But we still have to explain the why of the massive selling that happened for the 2 months prior.
We do. The outflows.
Right. Why did $4.5 billion just leave in the first place? Which brings us to the second part of our deep dive, smart money versus fast money. And to do that, we really need to dig into the basis trade.
Basis trade, yes.
Okay.
This is the absolute culprit. If you want to understand the really bizarre price action of 2024 and 2025, you fundamentally have to understand this specific trade.
I feel like I hear this term thrown around constantly on financial TV, but nobody actually explains how it works. I want you to really break it down. Explain it to me like I'm a 5-year-old. Or, maybe like I'm a reasonably smart 5-year-old who happens to have a brokerage account.
Okay, I can do that. Let's simplify it as much as possible. Imagine you can buy an apple today at the market for exactly $10.
Okay, I have my $10 apple.
That's the spot price.
Mm-hmm.
The price right this second. But while you're holding that apple, you find someone who signs a legally binding contract promising to buy that exact same apple from you in exactly 1 month for $11.
Okay, that's the futures contract.
Exactly. That is the futures price.
So wait, I buy it for 10, I have a guaranteed contract to sell it for 11. I just made $1 for doing absolutely nothing but waiting a month.
You got it. You buy the apple, which in this case is the spot ETF, and you simultaneously sell the futures contract. You have perfectly locked in that $1 profit.
Wow.
And here is the magic part. It literally does not matter if the price of apples goes to $100 or crashes to zero over that month.
Because I already locked in the sale price at 11.
Exactly. You have perfectly hedged your position. You just sit back and pocket the difference between the two prices, which we in the industry call the spread, or the yield.
I mean, that sounds literally like free money. Is it actually risk-free?
In financial terms, it is what we call delta neutral, meaning your exposure to the price actually moving up or down is zero.
You just don't care.
You absolutely don't care about the price of Bitcoin. You just care about that spread remaining intact until the contract expires. And for most of 2024 and 2025, because there was so much retail demand driving up the futures price, this specific trade was paying out 15 to 25% annualized.
25%. Essentially risk-free. Good grief. No wonder all the hedge funds were piling in. If I could get 25% risk-free, I'd remortgage my house.
Exactly. It was a golden era for these quantitative hedge funds. They were borrowing cheap money, buying the spot ETF in massive size, shorting the futures on the CME, and just printing cash. It was the easiest trade on Wall Street.
And I'm guessing there's a... But here, all good things must come to an end, right?
Yeah.
Here comes the collapse.
Right, because traditional markets are highly efficient. Eventually, word gets out. It's too good of a trade, so too many massive funds crowded into it.
Too many people buying the apples.
Yes, and crucially, too many people selling the futures contracts. When everyone rushes to the other side of the boat to sell the futures, the price of the futures inevitably comes down. It compresses.
So the spread tightens.
The spread tightens dramatically.
Ugh.
By early February of this year, 2026, that yield, that beautiful 25% profit margin, compressed all the way down to roughly 4%.
Oof. 4% is a whole lot different than 25%. That barely covers the cost of turning the lights on at a hedge fund.
Exactly. And here is the real expert analysis on why this caused the crash. Why on earth would a major hedge fund take the operational risk, the prime broker leverage risk, and deal with all the complexity of a crypto derivatives trade for a measly 4%?
When they could just, what, buy a treasury bond?
Exactly. They can just buy risk-free U.S. government treasuries and get a very similar, perfectly safe yield.
So they wouldn't take the crypto trade. They would just close it out and leave.
And that is exactly what they did. En masse. That perfectly explains the $4.5 billion exodus we saw.
Wow.
It wasn't that these Wall Street hedge funds suddenly woke up and hated the asset class or thought the underlying blockchain technology was failing.
It was just math.
It was purely 100% mechanical. The spreadsheet math no longer worked, so the trading algorithms just automatically unwound the positions.
You know, that is such a massive aha moment for me, and I think for a lot of you listening too, because when you just log into Twitter or look at a chart and see a giant sea of red outflows, you naturally emotionally think, oh no, everyone is losing faith. The big guys are dumping on us.
It's human nature to think that way. We attach emotion to red and green candles.
But you're saying it was literally just a calculator decision. Yield is down to 4%. close the trade, sell the ETF.
That's all it was. It was mechanical selling, not fundamental selling. And that is an absolutely critical distinction for long-term investors to grasp.
The fast money.
The fast money. The yield tourists looking for a quick arbitrage flip. They packed up their bags, checked out of the hotel, and left.
Okay, so the tourists are finally gone. The arbitrage guys have left the building. So
Right.
who is left? If they sold $4.5 billion, who was actually stepping in to buy the $1.1 billion this week?
This is where the underlying story gets incredibly bullish for the long-term health of the market.
I like bullish.
As the hedge funds left, a completely different, much larger beast entered the arena. We are talking about sovereign wealth funds and massive investment advisory platforms.
The big, slow money. The guys who manage trillions.
The real money, the money that actually moves mountains over a decade. Specifically, we got some incredible filing data this week showing that Abu Dhabi's sovereign wealth arm has been wildly aggressive.
Really? Abu Dhabi?
Yes, in the fourth quarter of 2025, they increased their IBIT holdings, that's the BlackRock ETF, by 46%.
A 46% increase? That isn't just dipping a toe in the water to see how it feels.
No, that is a massive, high-conviction allocation. They now hold well over $1 billion in that single BlackRock position alone.
That is massive. And correct me if I'm wrong, but a sovereign wealth fund representing a nation state, they aren't day trading, right? They certainly aren't sitting there doing the basis trade to scalp 4%.
Absolutely not. They aren't looking for an arbitrage flip. They operate on macro timeframes. They're looking for a 10-year, maybe 20-year strategic allocation. Yeah. This kind of capital is what we call sticky. When Abu Dhabi or a major pension fund buys an asset, they aren't going to panic sell it next Tuesday because the CPI print came in 0.1% higher than expected.
They don't care about the daily noise.
Exactly. They are parking capital for a generation. They see it as a permanent piece of a diversified global portfolio.
So essentially, we have systematically swapped out flighty, highly leveraged hedge funds for sovereign nations and deep-pocketed pension funds.
We have.
That feels like a massive upgrade in the overall quality of the holder base. It's like replacing the people flipping houses with people buying generational family estates.
That's a great analogy. It represents a fundamental maturation of the asset class. We are finally moving away from pure financial engineering, which was the entire basis, trade, to actual fundamental asset accumulation.
Okay, so the internal dynamics of the market are definitely shifting in a positive way. But we don't live in a vacuum. We don't live in a spreadsheet.
No, we definitely do not.
The outside world is totally chaotic right now. Which brings us to the third part of the deep dive, the macro backdrop. We have to talk about tariffs, courts, and inflation.
It has been a wildly volatile week for global policy. I'd argue maybe the wildest in the last few years.
Honestly, I saw the breaking news alerts on my phone about the Supreme Court ruling, and it sounded pretty intense. It sounded like they basically overturned a whole bunch of existing tariffs.
They did. It was a massive shock ruling that caught Wall Street completely off guard. They essentially invalidated a huge swath of existing legacy tariff structures.
On what grounds?
They argued it was executive overreach, that the previous implementations bypassed Congress in a way that violated trade statutes.
Wow.
It was huge. But, and this is classic high-stakes political chess, the current administration immediately fired back.
They didn't just take the L?
Not at all. Within hours of the ruling, they utilized a completely different set of emergency economic authorities to announce a new blanket 15% global tariff.
14% on literally everything coming in.
That is the initial announcement, yes. A universal 15% tariff.
That is, I mean, that's just a grenade thrown into the global supply chain.
Exactly. And this created massive, immediate uncertainty in global trade. Every single importer suddenly didn't know how to price their goods for next month.
Right, because if your costs just went up 15% overnight, your margins are obliterated.
Right. And usually, historically speaking, uncertainty is terrible for risk assets. The stock market hates not knowing what the rules of the game are.
It usually causes a huge sell-off.
Exactly. But Bitcoin is acting incredibly interesting in this specific environment.
It's doing that chaos hedge thing again, isn't it? We saw this a few years ago.
It's entirely doing the chaos hedge thing. When you have global trade wars, tariff fights, and supply chain breakdowns, you inevitably get currency instability.
Right.
If the global flow of goods breaks down, fiat currencies start to fluctuate wildly against each other. And when that happens, institutional investors immediately start looking for hard, borderless assets.
Which explains gold. because gold has been on an absolute tear.
Exactly. Gold is targeting $6,000 an ounce right now. It's moving parabolically. And Bitcoin is basically just drafting right behind it in its slipstream.
They are running together. It's the classic store value thesis finally waking up and doing what it was designed to do.
Exactly. They are both responding to fiat uncertainty. But there is a really dark downside to tariffs that we have to discuss.
Inflation.
Yes, tariffs are inherently inflationary. If you tax imports by 15%, those companies aren't just going to eat the loss.
No, they pass it right on to us. Prices go up for the everyday consumer at the grocery store, at the hardware store.
Exactly. And that brings us to this serious inflation nerves we saw this week with the newly released PPI data.
Okay, let's look at that. PPI, that's the Producer Price Index. For the listeners, this is essentially the inflation rate at the wholesale level, right? The cost for businesses before the goods even hit the retail shelves.
That's a perfect way to describe it.
Okay.
It is widely considered a leading indicator for the CPI, the Consumer Price Index, because whatever the producers pay today, the consumer pays tomorrow.
And the data released this week was hot.
Extremely hot. The headline PPI rose 0.5% month over month. And to give you context, the consensus expectation on Wall Street was only 0.3%.
So it completely blew past estimates. It came in way hotter than expected.
Much hotter.
Yeah.
And it gets worse under the hood. The core PPI, which strips out the volatile food and energy sectors, this is the metric the Federal Reserve actually stares at all day, it jumped 0.8%.
0.8% in a single month. That is a huge jump.
It's a massive acceleration.
So what does that actually mean for the Fed? Because we were all sitting here hoping for rate cuts this year.
It complicates things immensely for them. The Fed obviously wants to cut rates to stimulate the broader economy, especially commercial real estate. But if inflation is proving to be this sticky or worse, actually re-accelerating because of these new tariffs, their hands are tied.
They can't cut.
They absolutely cannot. They have to keep interest rates higher for longer to try and cool the economy down.
And this is where my brain breaks a little bit, because usually high interest rates are basically kryptonite for crypto and tech stocks.
That's the traditional textbook view, yes.
Right, because if rates are high, sitting in cash or a money market fund pays you 5% safely. So you don't need to go buy a volatile asset like Bitcoin to get a return. High rates should crush Bitcoin.
Usually, yes. But we are seeing a massive paradigm shift, a paradox in the market.
Explain the paradox.
You have to ask why rates are staying high. The root cause of this specific inflation isn't just a booming, healthy economy. It is tariff-driven currency instability and sovereign debt concerns. So even though interest rates might stay high, major investors are genuinely scared of the underlying U.S. dollar permanently losing its purchasing power due to the debt load and the trade wars.
So they are rushing for the exits of the fiat system entirely?
Yes. They are buying the hard assets gold and Bitcoin despite the hawkish interest rate outlook. Because a 5% yield on cash doesn't help you if the currency itself is being debased by 8% real inflation.
That is such a fascinating nuance. It totally flips the script. It's not just a simple equation of rates up means Bitcoin down. It's, wait, why are rates up? And if the answer is because the underlying fiat system is getting extremely messy, then Bitcoin actually wins.
Precisely. In this specific environment, it is acting as a pristine hedge against sovereign monetary disorder, not just a simple interest rate play.
Okay, wow. That covers the macro storm. Let's pivot to the fourth section here. We have talked about the institutional flows. We've talked about the macro chaos. Now I really want to get into the weeds of the market structure itself.
Let's do it.
Because there were some genuinely weird, almost unbelievable stories floating around this week. First off, we have to talk about the Bithumb glitch. Did you follow this live when it happened?
Yeah.
I did. It was impossible to miss if you were awake and watching the Asian trading session. It was a fat finger error that will literally go down in the history books.
Please walk everyone through exactly what happened, because the sheer numbers I was reading on social media were almost hard to believe.
Okay, so Bithumb is one of the major, highly regulated, centralized exchanges in South Korea. They do massive daily volume.
Right.
Apparently, there was a typo during a routine system update. Literally a catastrophic keystroke error by a database administrator.
A typo.
A simple typo. And it accidentally credited exactly 695 user accounts with phantom Bitcoin.
Wait, Phantom Bitcoin, like, it didn't actually exist.
Exactly. It completely did not exist on the actual Bitcoin blockchain. There were no real coins moved. It was literally just a display error numbers typed into a centralized SQL database.
Okay, but how many fake coins are we talking about?
The system erroneously credited these users with a combined total of 620,000 Bitcoin.
620,000. I actually did the back of the napkin math on that before we recorded. At current prices, that is roughly $44 billion.
$44 billion of entirely fake, unbacked value appearing in random retail user accounts instantly.
That is terrifying. And what do you think those 695 users did the second they logged in and saw their account balances explode to the moon?
Oh, we know exactly what they did. They immediately smashed the sell button.
Of course they did. I would have too. I'm a billionaire. Cash me out.
Exactly. They just market sold everything. And because that exchange has finite, real liquidity, dumping that much fake supply onto the local order book caused the price of Bitcoin on that specific exchange to crash 16% in a matter of minutes.
Absolute panic.
Utter panic. The order book was completely decimated.
But, and this is the wild part, the rest of the world just completely flatlined. The global spot price didn't blink.
And that is actually the good news hidden in this disaster. The systemic contagion didn't spread.
Why not? Why didn't arbitrage bots see the cheap coins in Korea and crash the U.S. markets too?
Because the arbitrage bots, these highly sophisticated automated trading programs, they realized very quickly that something was structurally wrong. They saw Bitcoin was trading at, say, 60 grand everywhere else in the world, but randomly dropped to 50 grand on Bitham.
The spread was massive.
Right, but the bots are smart enough to know they couldn't physically buy the cheap coins, withdraw them to the blockchain, and move the money fast enough to bridge the gap before the exchange halted withdrawals.
Ah, they knew Bitham would pull the plug.
Exactly. So the bots just shut themselves off and stayed completely away. The crash was totally contained to that one single database.
That's a huge relief. But it really exposes a deep underlying fragility, doesn't it?
It absolutely does. It brutally reminded everyone in the industry that when you leave your assets on a centralized exchange, your Bitcoin is literally just a digital IOU. It's just an entry in a private company's database until you actually withdraw it to your own cold storage.
Not your keys, not your coins, playing out in real time.
Exactly. And this specific glitch violently reignited that old fear of paper Bitcoin, the terrifying idea that these big centralized entities might be secretly printing infinite money that doesn't actually exist on chain.
And that paranoia, that fear, perfectly ties into the massive Jane Street conspiracy that was trending on every social media platform all week.
Oh boy, the lawsuits. I knew we were going to get here.
We have to. It was everywhere. For context, there was a completely separate lawsuit happening involving Terraform Labs. You know, the guys behind the Luna collapse a few years ago?
Right, the SEC discovery process.
Exactly. And in the discovery documents released this week, there were some wild accusations thrown around by lawyers against authorized participants, specifically naming firms like Jane Street.
Yep.
The rumor mill just went absolutely crazy. People were saying these massive Wall Street market makers are actively using complex derivatives to intentionally suppress the price of Bitcoin.
They are illegally shorting paper Bitcoin to keep the price down and steal from retail. Yeah, I saw the tweets. People were absolutely furious.
Right. And as our resident expert, I really need you to push back on this or explain it, because to the average guy who just lost money on a dip, it feels exactly the same as manipulation.
I totally understand why people feel that way. It's an incredibly fair question. But we desperately need to distinguish between malicious market manipulation and standard, highly regulated hedging mechanics.
Okay, what's the actual difference?
Let me walk you through exactly how the ETF plumbing works on a typical day.
Please do.
When a massive fund, like BlackRock's IBIT, receives $50 million from investors to buy Bitcoin, BlackRock doesn't just log on to Coinbase and click buy.
Right, they use middlemen.
They use what's called an authorized participant, or an AP, like Jane Street. Jane Street is legally obligated to deliver that actual physical Bitcoin to BlackRock's custodian by the end of the settlement period.
Okay, so Jane Street has to go out into the market and hunt down $50 million worth of real Bitcoin.
Exactly. But doing that takes time. And Jane Street is a risk-averse market maker. In the interim hours, while they are slowly sourcing those underlying coins across multiple exchanges to avoid moving the price too much, they have massive price exposure.
Because if Bitcoin crashes 10% while they are trying to buy it for BlackRock, they lose millions.
Exactly. They would lose their shirt. So to protect themselves, they aggressively hedge their temporary exposure using derivatives. They might short the CME futures contracts in equal size to lock in their price while they hunt for the spot Bitcoin.
So if they are tasked with buying 100 million of spot Bitcoin for BlackRock, they immediately short 100 million in futures so that if the price drops in the next 10 minutes, they remain totally flat.
You nailed it. It is pure, mathematically precise risk management.
Okay, but doesn't shorting the futures drive the price down?
It can, temporarily. Does it create short-term selling pressure in the derivatives market? Yes, absolutely. But is it a grand, shadowy conspiracy to destroy the core value of Bitcoin? No. It is literally just how the plumbing of a modern EPF functions. They eventually unwind that short once they acquire the real coins.
But you can see why in a week where a separate exchange accidentally prints $44 billion of fake Bitcoin, retail investors were absolutely primed and ready to believe any conspiracy theory about Wall Street printing fake coins.
Oh, completely. The timing was terrible. Tensions and paranoia were at all-time highs.
Fair enough. Okay, so that debunks the conspiracy. But there was one actual verified structural improvement in the market this week that didn't get enough attention, right? Something involving penny increments?
Yes. This is a bit geeky, but it is actually profoundly important for the maturity of the asset.
Lay it on us.
The CBOE just announced that IBIT options, the options contracts trading on BlackRock's Bitcoin ETF, are officially now trading in penny increments.
Okay, meaning what, practically?
Previously, the mandated difference between the absolute highest price a buyer was willing to pay and the lowest price a seller would accept. The spread was artificially capped at 5 cents or maybe 10 cents minimum. Now the exchange allows them to, quote, prices down to a 1-cent difference.
So it's essentially just way cheaper to trade.
Much cheaper for the end user. It massively tightens the bid-ask spreads. It dramatically lowers the friction and the cost of entry for anyone trying to hedge a portfolio.
And who does that attract?
Crucially, it makes the specific options market vastly more attractive to the giant high-frequency trading firms, the HFTs.
Why do we want the HFTs involved? I thought people hated them.
Because they provide infinite, instantaneous liquidity. They grease the underlying wheels of the entire market, making it significantly more efficient and incredibly liquid.
So basically, it's just much better plumbing.
Exactly. Better plumbing always leads to much better, more accurate price discovery. It is an incredibly bullish signal for the long-term institutional maturity of the crypto ETF market.
All right, that is fascinating. Let's move smoothly into Section 5. We have already established that the fast money hedge funds left and the massive sovereign wealth funds entered.
The great rotation.
But who else is doubling down right now? Let's talk corporate and institutional adoption. Because while retail is panicking, the big banks were actively making historic moves.
They really are. And the absolute standout headline this week is Morgan Stanley.
Morgan Stanley. Now, they have historically been kind of cautious, haven't they? They weren't exactly leading the charge like Fidelity.
They were very slow to the party compared to someone aggressive like BlackRock. But they're clearly making up for lost time right now. They just officially filed with the SEC for their very own native Bitcoin and Solana ETFs.
Solana, too. That's really interesting. It's not just Bitcoin anymore.
Yes, the inclusion of Solana is a massive regulatory and institutional signal in and of itself.
But that wasn't even the biggest part of their announcement.
No, the truly industry-shaking news is that Morgan Stanley announced they are internally building a native Bitcoin custody and prime exchange platform.
Wait. Explain native to me. Does that mean they aren't just going to partner with someone else and rely on Coinbase to actually hold the private keys?
Exactly.
Yeah.
Right now, almost all the traditional banks just rent the crypto infrastructure. They essentially white label Coinbase custody or Anchorage.
Because it's easier and the legal liability is offloaded.
Exactly. Morgan Stanley is changing the game. They officially want to own the entire underlying stack. They want to be the ultimate custodian holding the actual cryptographic keys.
That is deeply significant.
It really is, because it strongly signals that the Morgan Stanley Executive Board now sees crypto as a permanent generational revenue stream. You don't spend hundreds of millions of dollars building bespoke cryptographic security vaults if you think this is a passing fad.
Right. They aren't renting the apartment anymore. They are literally building the skyscraper.
Perfectly said.
That is huge. Because when the oldest, most conservative global banks start fiercely fighting over who gets the privilege of holding your Bitcoin, you know for a fact the asset class isn't going anywhere.
Correct. It is the ultimate vote of long-term confidence.
And while the mega banks are busy building the underlying plumbing, the ultimate corporate whale just keeps eating up the actual supply.
Oh, MicroStrategy, Michael Saylor.
We absolutely cannot do a weekly deep dive without checking in on the MSTR Treasury.
It's mandatory at this point.
Despite the insane volatility on Monday, despite the doom and gloom, they just calmly announced they bought another 592 Bitcoin this week.
Just another typical Tuesday morning for Michael Saylor.
Roughly $40 million worth, just scooped up. Their total corporate holdings are now sitting at roughly 717,722 Bitcoin.
That absolute sheer number is getting profoundly absurd.
I mean, they are rapidly approaching, what, 3 or 4% of the entire maximum global supply?
It is a staggering concentration of wealth. They are essentially the ultimate corporate whale that dictates the psychological floor of the market.
Explain that.
When the spot price dips violently, every single trader in the market knows there is a massive price-insensitive buyer, like MicroStrategy, just waiting to deploy capital. It provides a huge psychological backstop that prevents total freefall.
That makes total sense. They're the buyer of last resort. But there was actually one other much smaller corporate player that really caught my eye this week, GD Culture.
Yes, this is a fascinating, totally under-the-radar little story that I think hints at the future.
Tell me about them.
GD Culture is a much smaller, publicly traded company, but their board officially approved a major Bitcoin sale this week.
Okay, wait. They sold Bitcoin. I thought you said everyone was buying.
They did sell, but not because they wanted to flee the crypto market or because they lost faith.
Then why?
They systematically sold a portion of their Bitcoin treasury, specifically to fund a $100 million cash buyback of their own traditional company stock.
Oh, wow. That is actually an incredibly clever corporate finance maneuver. They basically used their appreciated Bitcoin treasury as a massive piggy bank to financially support and pump their own stock price.
Exactly. It perfectly demonstrates what we call operational liquidity.
Love that term.
For the longest time, the critics said, you can't do anything with Bitcoin on a corporate balance sheet. It's just a digital pet rock that sits there.
Right.
GD Culture just explicitly proved them wrong. You can seamlessly use it to directly fund highly complex corporate actions in the traditional fiat world. It completely legitimizes the strategy of using BTC as pristine collateral on a balance sheet.
It's not a religion, it's a financial tool.
Precisely. It is a highly liquid, highly functional corporate treasury asset.
All right, we have covered the chaotic past and the fascinating present. Let's look forward. Section 6, technical outlook and the path forward.
Let's pull up the charts.
If I am looking at the technical chart right now, zooming out past the daily noise, what are the actual key levels I need to be watching?
Okay, for everyone listening, get your mental notepads out. The hard support, the definitive buy zone we discussed earlier with the institutional flow data, is firmly entrenched between $60,000 and $64,000.
The line in the sand.
Yes, that specific zone is incredibly dense with institutional demand.
Okay.
As long as we structurally hold above that mid-60K range on a weekly closing basis, the overarching macro structure remains extremely bullish.
Okay, so that protects our downside, but what about the ceiling? Where do we actually need to break out to see some real excitement?
The massive overhead resistance is $95,000.
95K. Just shy of 6 figures.
That is the big psychological and technical number. We have touched it in the past, we have flirted with it on Wix, but we simply haven't broken through it cleanly with real sustained volume.
And what happens if we do?
If we solidly clear 95,000, we are instantly looking at blue sky territory.
Blue sky?
Yes, because historically there is literally zero trapped supply or resistance levels above that price.
Right.
It's uncharted territory.
That is the famed price discovery phase, where the asset just detaches and finds a completely new reality.
Exactly. It's pure upward price discovery. And frankly, there is one very specific underlying on-chain signal giving me immense optimism right now that we might actually get there soon.
Hit me with it.
The hash ribbon.
The hash ribbon indicator. Okay, this tracks the underlying network miners, right? The guy securing the blockchain.
Yes, it mathematically tracks miner profitability, health, and what we call capitulation.
Let's break that down.
When the price of Bitcoin drops violently, like it did early this year, the older, highly inefficient mining rigs suddenly become totally unprofitable to run. The electricity costs more than the Bitcoin they generate.
So they have to literally unplug them.
Yes, they forcefully turn off their machines, and they are forced to sell their remaining Bitcoin reserves on the open market just to avoid bankruptcy. This process is called minor capitulation.
And that's obviously a bad thing, right? Because they are dumping supply.
It feels incredibly bad in the moment. It adds massive sell pressure. But the hash-driven indicator tracks the exact mathematical moment when that forced selling pressure officially stops.
Okay.
And this week, the indicator just flashed a massive, confirmed macro buy signal.
Wow.
It is empirically telling us that the weak, over-leveraged miners are completely flushed out of the system. The network is fundamentally stabilizing. And historically, across multiple market cycles, this very specific signal almost always precedes a major multi-month parabolic rally.
Because the forced selling is just gone.
Exactly. It's arguably one of the most reliable long-term on-chain buy signals we have.
So just to summarize the sheer amount of data we've covered, the bankrupt miners are entirely done selling. The fast money hedge funds are officially done selling.
The structural sell-side pressure is actively drying up before our eyes.
And what about the overall market sentiment? Where is the psychology at today?
We are definitively moving away from extreme fear, which we absolutely saw dominating the timeline on Monday,
Right.
back to a healthy state of cautious optimism.
Cautious being the key word there.
Very key. It is definitely not euphoria yet, which is structurally a great thing. Euphoria is incredibly dangerous. Cautious optimism means there is still a massive wall of worry for the market to steadily climb. Investors are still inherently slightly skeptical.
And the wildly volatile stop-start nature of the ETF flows this week.
It heavily suggests we are currently locked in a massive consolidation phase. We are essentially just catching our breath, building a very solid floor, and waiting for the absolute next major macroeconomic catalyst.
What could that catalyst be?
Maybe it's sudden, clear regulatory clarity from Washington. Maybe it's the next unexpected move from the Federal Reserve on interest rates. Or maybe it is just the delayed mathematical reality of the supply shock finally hitting the open order books.
Man, what a week. So let's wrap this up. Let's really cleanly unpack the big takeaways for everyone listening.
The absolute core headline from this entire deep dive is simple. The brutal 2-month bleed has officially stopped. That massive $4.5 billion wound has finally been completely cauterized.
And underneath that, we have witnessed a fundamental generational changing of the guard in the holder base.
We have.
The fast money tourists, the highly leveraged hedge funds that were purely chasing that simple basis trade yield, they are officially out. They took their quick arbitrage profits, they closed up shop, and they went home.
And replacing them are the real money settlers.
Right.
The massive sovereign wealth funds out of the Middle East, the trillion-dollar investment advisors, the historic mega banks actively building native custody solutions. They are digging huge trenches. They are aggressively buying the dip for a 10-year hold.
And think about what the actual spot market miraculously withstood this week.
It was a gauntlet.
It absorbed a mind-bending $44 billion phantom glitch error in Asia, a totally unexpected massive global tariff shock from the U.S. government, incredibly hot wholesale inflation data, and despite all that incoming fire, it still managed to strongly reclaim $68,000.
That is the literal definition of market resilience.
Yeah.
That is deeply embedded structural strength.
So here is my final, slightly provocative closing thought for you listening today. We just spent basically all of 2024 and 2025 obsessively talking about the basis trade, right? We talked about how pure financial engineering was artificially driving all the ETF flows.
It dominated the narrative for 2 years.
Exactly. So if that highly lucrative basis trade is now definitively dead, if the arbitrage yields are compressed to almost nothing, but the massive ETF inflows are still returning, as we just saw this week, does that inherently mean the absolute next major price rally will be entirely driven by pure, organic, unadulterated demand for the core asset itself?
That is the ultimate question facing the market right now.
And if so, if we are moving away from leverage and towards actual spot demand, is that a dramatically healthier, far more explosive setup for the market going into late 2026? Are we actually finally seeing Bitcoin trade on its own fundamental merits rather than just acting as a convenient yield vehicle for Wall Street?
It certainly looks exactly that way right now. The data points directly to it. And if that is indeed the case, the potential upside constraint could be far, far higher and way more sustainable than anything we experienced last year.
That is definitely something to chew on over the weekend. Thank you so much for listening to the Pro Ticker Deep Dive.
Stay curious out there and definitely keep a very close eye on those daily fund flows.
We'll see you next time.